And so this next section, Gautam Mehra, who's a partner and leader of the tax and regulatory spearhead of PwC, is going to bring his experts up and quiz them on some of these issues and many more. Please welcome Gautam and his panel.
Thanks, Peter. India, there's a story of, holding on to your chair, so we're just coordinating that. But as they get that up, I think, as somebody mentioned in the morning, this is yet another REIT conference. And I think the only difference I see in this REIT conference vis-a-vis the earlier ones is hopefully before we have the next REIT conference, we will at least have a REIT registration, if not a listing. So we'll start off on that positive note, and there was talk of grey hair. I think the only advantage of being around for the last 15 years in real estate is that you've seen the definition of REITs evolve from a real estate investment tourist to actually a real estate investment trust, or what it should be. It's been a long journey, but hopefully land on a good note. With that, let me invite three individuals who individually and as part of the organizations have had some fantastic experiences on REITs. It's a great platform. I will ask them a few easy questions and then towards the end open the floor for you to ask them the more tough ones. Please join me in welcoming firstly Stuart from APREA Management. Stuart is based in Kuala Lumpur. He's a founder of a private equity fund in real estate, but I think one thing to the credit, you can look it up, is Stuart was the person who took the first REIT listing in Malaysia. So Stuart, welcome. We have Sanjeev from Singapore, a very well-known face in the Indian real estate market. He's been earlier with ICICI Ventures here, and now, of course, is a senior person at Ascendas. As you know, Ascendas has a REIT listed in Singapore, which is India-focused, besides a lot of other stuff on real estate in India. And last but not the least, Ankur. Don't go by his young looks. I think the experience as part of the Brookfield team over the last, 7+ years, and been particularly active in India. What you all may not know about Brookfield is that they're a large REITs player in the US. And I think Ankur has been involved with some of that, maybe if not directly involved in taking REITs listing, but probably getting REITs delisted. So that's the other side of the story as well. With that, let me directly kick off into a few, as I said, the easy questions for them, and then I'll open the floor for all of you. So one interesting fact that came out in the morning, I think Peter mentioned about India now having $1 trillion of investment-grade, income-generating real estate. And that's great news from a REITs perspective. Probably a lot of that is sitting in unlisted SPVs or some of them in listed companies as well. And the first question I wanted to throw out to the panelists is, how different is it investing in real estate through a REITs or managing through a REITs vis-a-vis through what is probably presently happening in India more through the un-REIT market? Stuart, maybe start with you.
Okay. The Malaysian experience is quite different from the Indian. Mind you, your experience is yet to start, and I'm sure as you move down the road, things will change. It happened in Malaysia as well. When I first listed, I had to withdraw my prospectus 3 times as they kept changing the regulations. It was a work in progress. And that's another story for another time. But what we have in Malaysia is that we have direct investments by REITs. REITs buy assets onto their balance sheet, and they're basically held by a trustee on behalf of the unit holders. It's a very simple structure. I would say that REITs are probably the simplest corporate structure you can ever find, because it means that you're running almost like a society. Income, expenditure, profit, that's it. There's no sort of cross subsidiary accounting or things like that. But here in India, I noticed that you're all held through SPVs. Now that's something that's very different. Malaysia don't run the SPV route very often, because if they do, they get penalized on the tax, because the SPVs are not tax transparent. So they get paid the corporate tax, and then the money, the dividends can be then escalated up to the REIT itself. So there's a leakage of 25% in income, and it's not very favored by the REIT managers themselves or the investors. So that's a no-no. We're fighting very hard with the regulators to allow the SPVs to enjoy the same tax benefits as the REIT itself. Now, the regulations in Malaysia state that if a REIT distributes more than 90% of its income, it doesn't pay tax at all. And the individuals are taxed in different layers. Individuals will pay a 10% withholding tax, and corporates 25%, or the current corporate tax rate. So it all depends on how people look at the investments, and of course the institutions, if they're tax exempt, pay none at all. So the stock tends to be very favored by the pension funds. I asked a question earlier to you about, are the pension funds excited about REITs, but I believe there are restrictions here. But they're going to be a biggest market as a REIT investor. You find that they buy huge chunks of stocks and just lock them up. They very rarely trade them. So the liquidity in REITs, if there's a big institutional investor involved, tends to be fairly, very low. You don't have much free float at all. They just keep all the stock to themselves, keep adding, because what they want is cash dividends to pay their unit holders at the end of the year. And REITs provide the most clear and regular payments of dividends of any asset class in the market. They're predicated to pay either quarterly or half-yearly. So that's the big advantage that they see from institutional investors. And I suppose insurance companies like them as well, because they also benefit from the tax play there as well. And I think that's part of the reason that I see that, you get this big difference between how you own assets in different jurisdictions. I think the Indian experience is yet to be tested, and we'll have to see how the tax people view it and how that all works.
Sanjeev, you probably had experience both sides. You have a Singapore-based India REIT, and of course investing, through the unREIT model as well. Your comments?
So yeah, I think the fundamental part of a REIT is it's really a capital management engine, which is continuously raising equity and debt financing and providing its investors with a stable dividend yield. So what that does is that it also therefore imposes a lot of constraints in terms of how that business is run, because in terms of investing, financing, etc., one of the paramount objectives is always to be able to distribute dividend to shareholders. And I think what that does is it brings a lot of investing discipline to what you can or cannot do. I think the other thing which it does also is, from a corporate governance standpoint, the regulations are a lot tighter than if these same investments were done in a private format, be it private equity fund or balance sheet capital. So interestingly enough, what all of that seems to have done, if I look at the S-REIT market in Singapore, which is now about $60 billion US dollars plus, and with a history of about almost 15 years, is the ability to consistently pay out dividend, run a business with strong governance and strong investing discipline, has led to shareholder returns in REITs almost on a level that's comparable with listed developers. So you would argue that listed developers should have a much higher shareholder return, given that there's a lot of development gain that they generate. But because this asset class attracts very large pools of capital of the nature that Stuart was talking about, that has created the momentum for this growth. So in addition to whatever 6%, 6, 7, 8% dividend yield, the share price appreciation in the S-REIT universe the last 5 years has delivered almost an additional, about 16, 17% per annum. So you've got, at least the data that I recall as of March 2017, the S-REIT shareholder returns were, total shareholder returns were about 23, 24% for a 5-year period, and the listed developers was about 25%. So the delta was almost negligible. So I think that's kind of the interesting thing. Of course, I think the benefits of investing through private capital are, one has far greater operational flexibility. So one could technically, invest in opportunities that could create far greater value, at least in terms of profitability. But then, of course, that also comes with more risk and attracts a different kind of an investor base. So I think that's really the difference.
Very interesting, especially about the discipline part that you mentioned and the returns. And given the track record that we've had on the unREIT side in real estate specifically, I think that's good to hear. Ankur, you've seen this in the US, right?
Yeah, so the US market, sorry, the US market in the last year, or actually more than a year now, as Sanjeev was saying, the private capital lends itself to more flexibility. You can invest large sums of capital into more creative ways of investing in real estate. And that's played out pretty well in especially the North American markets. You've had a series of REITs that have been taken private. If you think about, there was a question asked about premium to net asset value, and lots of different parameters in which REITs can be valued. You have FFO matrices, you have NAV to discount, you have cap rates. All of them can triangulate to what is the inherent value of a business, but when it does not trade at that valuation, it creates interesting opportunities for private capital. And that's what is played out in the US over the past many years. The last 12 months return for REITs have been, I think, less than a point, so less than 1%. That's total return. Now, when REITs are trading at on a median basis about 6 cap rate, and there is not a lot of leverage in these REITs, why would total returns be south of even the government treasury rates? 10-year treasury is about 2.5% in the US today, slightly more than that last week, or whatever. But what's happened is private capital, because of the flexibility that it allows investors to invest in growth, invest in lease up, invest in some developments, has really attracted more institutional side of things. So you have a lot of private fundraising happening with large sponsors like us, and that has played itself on the other side of the equation. So like in Singapore, REITs have delivered a lot of returns. Today, most large REITs, especially in office, retail, and apartments, are trading at significant discount to value. So the North American market is seeing the other side of REITs, where because the REITs don't have the currency to invest in growth, it's actually becoming a negative feedback loop. That being said, sectors which are more, I would say, quirky, like manufactured housing, student housing, self-storage, net lease sectors, are trading at significant premium to net asset value. So, over a continuum, I think REITs do supply investors 3 things. Sanjeev you touched about governance and growth, but REITs, there's a third element which I think is very important in REITs, which is guidance. And what guidance is being given to the street is extremely important if you have to have REITs perform or outperform more, I would say, fixed income type returns over a long period of time. Because if you take out the public market listing aspect of a REIT is nothing more than a tax election.
Thanks. And so let me ask a question which is probably the hot topic of the day. It's 2 parts. The first one is not so hot, but the second one is there would be obviously a lot of debate about what's the kind of asset class that India should start off with. I think just based on what we're hearing, looks like commercial. But a slightly more broader question, I remember a discussion we had with the banking regulators at some time with bad loans being where they were saying, why did you get the banks immobile property REIT? And it's a great idea for capitalization of banks. But so if I were to ask you next 24 months versus the next 5 years, right? What's the kind of asset classes, opportunities you would see here in India? But the second question would be, you're all familiar with the India government bond rates. You're familiar with what the returns on the Indian real assets are. What would be a good starting yield expectation for the first REIT as it hits the road? Right. So because that's been really discussed and debated. So Ankur, let me go with you first.
Yeah. I mean, it's a tough question because we haven't seen the first REIT in India. I would say on the private market side, we never look at current yield as the end game of investing in anything. It's all about the profile of those cash flows. And I would weave the second part of your question about what type of assets are attractive. Because yield for a hotel could evaporate in 24 hours. Yield for apartments can evaporate in a month. Yield for an office building could be there for 10 years or more. So for us, investing in any asset type, and for the public markets in general, when the REITs do happen, it will be about the quality of that yield and the growth characteristic that is standing behind that income stream. So, we have a large portfolio in India, and we are very happy with the way performance has happened at the asset level. Now, a REIT is a collection of assets, and it is more than just a collection of assets. It's about corporate governance. It's about capital allocation decisions. It's about when to buy and sell. It's about how to have your liability side of the business managed appropriately. So it's more than just assets. And I think just putting a cap rate or a yield would not tell the whole story. And to answer your first part about which assets, I think the most investable asset type today in India is commercial office space. So I would suggest that, or at least the market suggests that will be the leader and probably the only real asset type for the REIT business for a very long time in India.
So, no, thanks for that, and you're absolutely right. I think the yields would depend on the quality of the assets and kind of assets, but just based on your experience in US, and if you've had any discussions with what investor expectations would be for a commercial real estate in India, investment grade, what do you think investors would be looking at, especially somebody from overseas?
So, on the private market side, cost of capital for investing in commercial real estate should be at a spread to what people can invest on a risk-free basis. So if the risk-free rates are gravitating towards an 8% mark, investors should, on a cost of capital basis, want to own at least something which is in the zip code of 11 to 12%. If the country is growing at real growth of 7%, now the numbers could be moving around a little bit, but given that REITs should ideally have a more stable growth profile, so even at a discount to that growth, call it 3 to 4% annualized growth, investors should be at least targeting 11 to 13% overall return. Whether that comes from income or from growth or a combination, that's probably the zip code here.
Thanks, I think that's really useful. Sanjeev, your take on this?
So I think if you look at the last maybe 10 years or so, at least in all the Asian markets, I think barring Hong Kong, what has not seen any other REIT market where dividend yields have not been at anywhere between 100 to 300 basis point premium over 10-year treasury for that currency. And Hong Kong is very different because it gets such a huge flood of mainland Chinese capital that it skews the yield significantly. But otherwise, so and if I just combine that with the conversations that we have with the institutional investors, a very large part of our shareholders are US institutions, the BlackRocks, the Fidelities of this world, and they all expect a premium to G-Secs in order to justify investing, because the asset class is somewhere between equity, fixed income and equity. So I think I would be surprised that long term if India investor expectations are different. Now, I think there are, the Indian domestic investors may have different expectations to foreign investors coming in, because foreign investors, for them, I think as Jim was mentioning in his discussion earlier, for a portfolio manager sitting in a London or a New York or a Hong Kong, India might be 2% of their capital allocation. So they have a choice to go wherever the returns are the highest, after taking into account risk-free rates, currency risk, and all of that. And the interesting thing is a lot of the other markets actually deliver fairly strong rental growth. It's not that rental growth in many of the developed markets has necessarily slowed down. I mean, if I just look at Singapore, it went through a correction 3 years back where commercial, prime commercial, let's say a Marina Bay kind of a financial center kind of area softened from about $10.50 to 11, and now it's dropped to about 8 or 9, and now it's gone all the way back up. So it's like, you know, the rentals have appreciated like 20% in the last 18 months. So it's not that the Indian growth is necessarily so much of an outlier for it to justify why return should be below, treasury.
So Stuart, I know you've had unlisted REITs in KL, but what's been the experience there?
Well, I think if you look at, one thing you must understand about your market, the REITs will actually open the door for foreign investors to come in. They all need to get exposure to India. It's going to be probably the third largest economy in the world one day. Congratulations to all of you. And it can't be ignored. So whatever it is, they have to jump in feet first. So they don't look at the theoretical number. They'll come in and they're probably looking at not a huge premium, but a small premium to the risk-free rate. I would think that from experience, 200 basis points above your risk-free would probably be a reasonable starting point. But also remember, this is your first REIT, and you can't afford to fail. Because when I listed our REIT, we put what we call change on the table. Okay? We discounted our assets by nearly 10% before we listed it. We gave a discount to the market. So people who came in actually had a gain from day one. Okay? It sounds a bit strange to do. I mean, everyone's pretty mercenary, I know these days, but we thought that if you really want to make this market work, the first REIT has got to have a pop on day one. It has to be hugely successful in order to make this market work. If it fails, you have a hard time clawing your way back from that. So I think in terms of strategy, it's not just what you list at, it's how you lead this market forward. And first mover advantage is always very, very important for anyone that lists first, getting there first. And I think that you have to look at the results. I'll just give you an example of what happened to us. We listed at a share price of $1.25 ringgit. We gave a guaranteed yield to the market, cash yield of over 7%. Okay? We were 19 times oversubscribed. We had no idea. And institutions were coming in and piling in because they wanted exposure to the first REIT. So there's a huge demand. And what happened? It listed, the placements that went out post setting the price were at 134. It opened at 165. So people actually who put that change on the table got it all back day one. They didn't, and it never looked back. The thing is that if you are looking at building this market up, the first mover has got to be a little generous. I hope Embassy's not going to shoot me here, but this is what happens in markets. If the first Indian REIT is a huge success, you're going to get people lining up to come behind that first one and list. It really is. And you talk about the premium, maybe we listed about 300 basis points above. It was generous, I agree. But I think for this market, maybe 150 to 200 may be reasonable. But don't forget what happened in Singapore. Capital Malls had to pull their first REIT. They were the first one to list. They had to pull it. I think Peter, you testified to that. They went at a very, very low yield. The market said, not interested. Because what you must understand here is that your investors in India don't understand REITs at all. In order to list a REIT, you have to spend 18 months talking to the markets, getting the papers to run articles, getting the people comfortable with it, because they don't know what on earth a REIT is. They have no idea what the returns are. They have no idea what the risks are. No one's explaining it to them. We're all experts here. We know all about it. All of you here are experts. But the investors out there have no clue what a REIT is. They think you might be unit trust. The fact that trust is there, it gets very confused with the mutual funds, all those other fund instruments out there in the market. And they get confused. They think, oh, is there a price? You have to pay 5% in. They take 5% away from my investment when I move in like the mutual funds do or not. Nothing's explained to them. The participation from the public was terrible. The first time I actually addressed a crowd of nearly 1,000 investors at one of the big events organized by the banks, I asked a simple question. How many people in the hall are invested in REITs? 4 hands went up. You're going to face the same challenges here, but your retail investors are your biggest strength. You won't need foreign investors for your REIT, trust me. There's plenty of capacity in your own country to subscribe to your own shares. It gives a chance for all the vast population to have a stake in the assets of the country and get a regular dividend in return, which is far more stable than the volatility that goes on with the share markets. But the whole public relations exercise has got to actually be created in the market here itself. the people who are actually investing, your investing public must be educated and tutored on REITs. And the second thing that was very important, the developments that we did, all the REIT managers, of course, when we developed a certain number of REIT managers, we formed our own association, become a pressure group to work with the regulators. Where we felt we had a need to change regulation that wasn't working, we had a common voice to go to the regulators. The regulators didn't want to speak to one REIT after another coming and asking for changes. They wanted us to speak with a single voice. So we have a unified sort of approach, and that's worked very well. That is what led to the big regulatory change in Malaysia recently, where all the REITs regulations were reviewed. It took us 4 years, but if you keep chipping at it, you do get a regime which actually works for you. So I think if you answer the question, I think 200 basis points will work.
So that's a great different perspective on the first REIT listing, and I'm sure there are a lot of sponsors and developers and investors over here. But Stuart, very interesting you mentioned about your experience hitting the ground. But as you went into the REIT space, and because you were the first one, is there anything else you'd like to share with the audience? Because maybe some players over here may be stepping into exactly your shoes in India over the next 6 to 12 months.
The beautiful part of being the first is you have no competition. If you're successful on your first listing, you have unlimited source of capital backing you. Your investors are very happy to take placements, and you can go out and buy stuff. And you can buy stuff, very quickly. You have the capital behind you. You can actually ramp up the portfolio very, very quickly. Provided you run a very clever asset capital management program internally, you can actually reduce the cost of borrowings quite considerably. Once the banks see you performing well, they really start to trust you. It took us a year to get the market to believe in us. After that, then the banks started popping in. The first time I went for a placement, we nearly didn't make it. We just squeaked through. So there wasn't that much confidence after the first time we did a placement. But after that, we used to do our placements in 2 hours. We go to the market, we raise, $200–300 million. We just go and visit a few people, a few phone calls, and we just close. And it'll be oversubscribed. Once you're actually on a roll, the key really to actually having a successful REIT is to make sure you run at a premium to NAV. The net asset value, run a premium. Your weighted average cost of capital comes down, you can buy very competitively, and you can accrete every purchase you make. And when you do that, your distribution starts to rise. When that rises, your share price tracks along with it. And if the markets see you're growing, they'll give you a lower yield. They'll pay more for your share price and take a lower yield, knowing that the catch-up will be there. But if you're running flat, I'm sorry, they're going to lose interest and leave you. The total return story is the key to it. A premium to net asset value, making sure that your properties are performing above the market. That's the key. That the rents they're getting, the performance of the rents, and the new additions you're putting in are all very accretive, and it really, really helps get the momentum in your own REIT running. And you should really target for very, very high build-up rate as you start your journey. And buy outside. There's always this question of sponsors, and it creates a lot of problems in the market that some REITs just wait for their sponsors to give them stock. They don't go outside. But the idea is really to go out and prove that you can buy openly in the market and buy well. That's a very key, and the investors look at that. Can you buy independently from your sponsors or not? And that's the true test of a good manager, that they go out there and buy in the market good quality products and bring them into the portfolio, as well as getting stuff from the sponsors. It's nice having a sponsor. It's a guaranteed pipeline, but there's a lot of other assets out there you can go for.
Quick follow-on. In hindsight, would you have preferred to be the guinea pig going in, or would you have preferred to wait for someone else to be the first one?
Well, I've just started a new one, okay? So say guinea pig or not. I mean, it was a different thing. The recent REIT I've actually I've actually started in Malaysia, is the first private REIT. Okay, that's another story for another time. And I know you actually have regulations here to effect that. But it took us 2 years to get the regulators to approve it. They're highly suspicious of private REITs. And we don't have any tax benefits, by the way. But getting that journey was it was like a startup, really, on a new sort of type of REIT. But it was interesting, and I found it very beneficial.
Excellent. Sanjeev, slightly different note. You've had an India REIT listed in Singapore. And, what do you see the differences, or how would managers or investors view a domestically listed REIT vis-a-vis an offshore listed REIT? And, how does it change? We heard about capital allocation being the key differentiator because multiple asset classes. So does this change, the way financing happens, or what's the key differences as you see in these two?
Yeah, I mean, on the capital market side, I don't think the difference is that significant in the sense that big foreign investors investing in the Indian equity markets are quite similar to those investing in the REIT markets. I think the four big guys who control probably 60% of global listed equities, which is BlackRock, Vanguard, Fidelity, and there's one more, State Street, I think. So I think it's the same names and many others. But I think the key difference basically is on the debt financing, which is very, very critical for a REIT. It's almost like the engine for it to grow. In most markets, acquisition funding is available at pricing which is below the yield of the property at the point of acquisition, which in India is a challenge. I mean, in India, if you're buying an asset at whatever, maybe 8.5%, 9%, getting acquisition funding at that point of time at that price is almost impossible. Or even if you get it, so it's going to be basically an acquisition could end up as DPU dilutive at the point of acquisition, or and even if it's not DPU dilutive, it's actually a pretty hard sell to go to investors on the equity side and say, I'm going and doing this big acquisition. After 3 years, I'm going to start making money, because they think that you're just buying these assets to increase your fee income. Because you go and do a big acquisition, irrespective of whether or not it makes money for the unit holders, your fee income goes up. And so people are very skeptical of non-accretive acquisitions, and so that's where I think the big differentiator is. The other thing, of course, which I think the Indian listed companies, generally the track record on governance is quite good. I mean, if you look at sectors like IT and so on, and there are some very, very well-respected promoter groups in India, but unfortunately on the listed real estate developer side, the experience has been patchy. And that, I think, still weighs on the minds of listed equity investors to a certain extent. And I think that is really going to be the key test for the sustainability of the Indian REIT listings, really. Can the governance be of the standard that is expected by REIT investors?
Absolutely, and that's a great advantage that established REIT managers have on bringing the governance piece. Ankur, again, talking of the financing or any of the stuff that you heard Sanjeev and Stuart mention on India, how do you see that financing piece playing out?
Sanjeev is right. Investors will ding a traditional REIT if it makes non-accretive acquisitions. So in India, cost of financing is 9% or 9.5%, depending upon who your source is. And market yields, going in yields, are not 9% today on stable assets. But I have a difference of view from my co-panelists here. Any stock in India, whether it's a REIT stock or any other stock, if you just look at current return for a marketplace like India, with inflation eroding a lot of your, if it's a foreign investor, FX depreciation in India could be 4 to 5% a year. So if market yields are 8% and you take out 4% from your current yield for FX, you're getting into a 4% zip code on a US dollar basis or for an international currency benchmark. It can never justify investing in real estate, because if you can make more money investing in core Western markets on a pure current yield basis, nobody can ever justify buying Indian story or Indian private or public REITs. It has to be driven by overall growth. And the fundamental business, the office business in India, has had great fundamentals. You've had rent growth, you've had occupancy growth, you've had demand drivers that are very positive for the sector. So all of this ecosystem has to work. REITs in isolation are just a way to capitalize commercial real estate. They will not work in tandem. You read stories about REITs will revolutionize commercial real estate space and all the rest of it. I think it's a lot of media, it's a lot of hashtag media. REITs in isolation will not work for India. REITs have to work in an ecosystem where developers are building good quality real estate. There is demand from tenants. Financing becomes more creative, so it's more accretive rather than being punitive and all the lenders using the same paintbrush for a developer or for a REIT sponsor. And finally, analyst coverage, reporting, governance, and finally media. So I think in that ecosystem, if you put the context of an Indian REIT, I would hope that it's not just a current yield game. Because if it's a current yield game, private market is a much better place to play India?
Thanks, thanks for that. I've been hogging the limelight by asking all the questions. We've got another 5-10 minutes. I just thought I'll open the floor. If any of you all have got questions for the panelists, raise your hand and we can do that. Else I've got a couple of more questions with me, but thought I'll give you all the chance first. Everybody's spellbound by still digesting. Yeah, there's one question there. If you get the mic in the middle.
Sanjay, you mentioned Singapore REIT has accumulated over $60 billion over the last 15 years. So they also had initially the same kind of problem what the other REITs faced in the initial turbulence. So what kind of lessons India can take it in advance so that when they are ready with the REIT, they can get prepared?
Yeah, well, I think Stuart kind of made the answer to that question easy because actually the Capita malls is a pretty good example where actually REIT tried to list at a very, very full value on day one, and it just didn't get the traction. And there was a lot of push from MAS, the regulator, and SGX because they really felt that Singapore was well primed for this asset class. And also, in a sense, the big sovereign wealth funds of Singapore who also have a lot of property portfolio exposure felt that they would like to see the REIT capital market develop. So actually people readjusted valuations at the point of listing. So valuations were discounted to make sure that there is a pop on listing. And that was possibly something which, that was money left on the table for a year or two. But as the market evolved, as investors saw the value of the model and the fundamentals of the property market, actually that yield contracted. So which is again the same thing, which is that do you try to monetize the entire value of the asset on day one, or do you stay as a long-term sponsor and benefit from the upside over time?
When you mentioned 22% returns already, that Singapore REIT is giving, vis-a-vis how the foreign investors going to look at India REIT, which is talking about 8 to 10%?
So I mean, partly because our properties are in India, we listed in Singapore, so I think we do get this or end up having this conversation with a lot of investors who would possibly also be investors in Indian REITs. And the sense that we get from them is that they would expect a total shareholder return in rupee terms of anywhere between 12 to 15% for them to want to invest in REITs in India. Because if you take a 8.5% property yield and you strip out taxes and fees, you're down to 6.5%, and a currency depreciation of another 4 to 5%. So if you really look at it, for a foreign investor, he's going to get a dollar return of 2%. So there has to be a share price appreciation in that return for it to be attractive. And that, so in addition to, let's say, an yield of 6-7%, they would like to see another 6-7, I'd say anywhere between 5 to 7% coming out of share price appreciation.
Thank you.
Hi, thanks for a very engaging discussion. I have one question to the panelists, and especially because three of you are Indian origin naturally. Typically, for any markets in India to develop, it requires the big boys of the insurance companies and the EPFOs to come together to start channelizing a market for that particular asset. Is there any talk currently in the government spectrum where insurance companies, just like you said that, to raise equity money, it's difficult because as an investor, you would want to have a higher yield. So is there any talk currently in the government circles where we are lobbying as an industry on REITs to kind of attract that capital?
I think Gautam is the best person to answer that question among the three of us.
No, the best person to answer the question would be Mr. Barua, who's coming in later today. Yes, there have been discussions, specifically around the REITs piece as well, but more broadly across, investing in alternatives. The pension thing is coming up hugely. Insurance companies, there's been some tweaking the regulations to permit some more investments in alternatives, not specifically on the REIT side. So I think that's work in progress, and I think it'll be good to get a current update from Mr. Barua when he's here later today. But certainly, I think the story that people want to see and are seeing is that Stuart mentioned there's enough of domestic capital waiting to be deployed here. Some of the taps have to be opened up, some of the restrictions have to be eased off, and more than enough over here itself.
I would just add to that, if the Indian REITs are a story about attracting foreign capital only, then I think the story will have a very short life. There is enough and more avenues for foreign investors to invest capital in Indian real estate through private funds like sponsors like Brookfield or Blackstone or S&S and many others. I think the true success of Indian REITs will be contingent upon how domestic capital views the story, because today in India, insurance companies, pension funds, even retail investors really don't have any avenue to play the commercial real estate story. All they can do is buy a building, small building or a house, whereas this is one of the largest asset classes in the world today. And the entire market is starved of a way or an instrument to invest in that in a fairly liquid manner. So I completely agree with you. Compared to any other market where insurance companies can invest in debt or equity in commercial real estate and actually call it good capital, India does not have that avenue right now.
So I think we're 46 seconds down to closure and bang on time. Please join me in thanking the panelists for a very engaging and candid discussion. Thank you so much.
And please thank Gautam Mehra for his superb moderation. Ladies and gentlemen, we've had a fantastic start to the day. We're now going to have morning tea for 20 minutes. If you could be back in 20 minutes, please. And then we're going to deep dive further into India. And then we're going to have an interview with one of the leading investment bankers who is extremely familiar with REIT IPOs in the Asia-Pacific, Martin Seah. Thank you.